So look, this is going to be pretty unstructured. There's going to be no slides. It's going to be, I guess, reasonably personal, and I'll try and keep it to time. And I won't look at the chat. So I mean, you know, if you've got any questions, please do let me know. So I mean, you know, Melanie's kind of given you my background. I guess sort of, you know, I wanted to sort of start at how I got into finance. I mean, I had absolutely no finance background. I wasn't one of those kids that kind of read the FT or traded shares or anything like that. I had absolutely no interest. My parents had none. My parents worked in conservation. I kind of grew up wanting to be a vet. And then I drifted into doing medieval history at university. I'd done a bit of maths and economics as well, but I certainly had no interest in finance. I wanted to travel. So after university, I got a job in Asia, working in sort of shipping and agriculture. And then I drifted into finance through a sort of series of coincidences in sort of the mid 1990s. And after that, as Melanie said, I was a fund manager in, you know, completely degenerative finance for kind of most of the next 25 years. Worked for a couple of sort of quite well-known private privately held fund management groups in the UK and France, worked for a startup in Geneva, worked for a listed hedge fund in the UK. I was kind of given portfolios to manage straight away, again, by a series of coincidences. I mean, most people spend, you know, a long time kind of being junior analysts and that kind of stuff. I was actually managing money in sort of Eastern Europe. So in the mid 90s, so not long after the breakup of the Soviet Union, and you know, so you know, but actually I look back at that and think, oh my God, you know, I mean, how on earth was I trusted with anyone's money back then? Emerging markets. I mean, I said that I love travel, and the thing that really attracted me to fund management was the emerging market side, I guess. You know, I spent a lot of time, as I say, in sort of Eastern Europe and Russia in the 90s, a lot of time in kind of China, India, and Brazil in the 2000s, 2010s. And you know, but left in 2018, which I'll sort of come to, and what I've done since then. I mean, Melanie mentioned a bit of it. You know, I mean, I guess, you know, I found finance very degenerative. I found it very, I was very disillusioned by it. I think it made me very ill, very mentally ill. I suffered from depression throughout, you know, a lot of my time, certainly the last 10, 15 years in finance. And I don't think that's that unusual. And it's one of the things that sort of struck me with finance is just, you know, and it struck me quite early on, just how self-centered it is. You know, I mentioned sort of wanting to be a vet, maybe wanting to be a teacher. I mean, those are kind of vocations. You do those because I want to help someone. I want to help animals. I want to help children, or I want to, you know, do this. Nobody does that when they go into finance. You do it for self-centered reasons. Clearly, one of the biggest ones is I want to make money for me. I think I'd be good at it, again, around me. I'm good at maths, around me. I want to be in a position of power, you know, around me. And fund management, by the way, is a very sort of, you know, if you like power, it's the biggest power sort of ego trip that you can possibly get, because you've got investment bankers and brokers and company CFOs and et cetera, all kind of thinking you're God. And you don't really even have to answer the clients, because you've got salespeople that do that for you. So it's an extraordinary sort of self-centered world. It's also very, very heterogeneous. I mean, I was thinking about this and I thought, have I ever had a woman or someone of color who was senior to me at any time in my fund management career? And I've come up with one woman. You know, I can't think of anyone else. I mean, obviously there are women around and all that kind of stuff, but I mean, there's no one senior to me. Yeah, I think, you know, I think once you see some of those things in finance, you sort of can't unsee them. You know, it's kind of like The Matrix or 1984 or something. You know, you live with that. And I think that the way that a lot of people deal with that fundamental kind of cognitive dissonance is by focusing even more on oneself. you know, I don't really like this job, but it pays my great big mortgage, or it sends my kids to private school, or you know, I really want that promotion, or look at, you know, look at my name in lights, all that kind of stuff. So it's very, very self-centered. You know, and so this sort of story of separation, which I think we all suffer from, this story of not being able to kind of connect enough with the world and with nature and with other people, I think finance kind of sets you up for that. And you know, I mean, I suppose it is important that I talk about sort of greed and bad actors. There are bad actors in finance. You know, I think there's a stat which says there are 10 times more psychopaths in finance than there are anywhere else. I mean, that's probably got to do with the fact there's 10 times more men than anywhere else. But, you know, I don't, and I've certainly met psychopaths. I mean, I would say at least 2 of my bosses were psychopaths. One was a nasty psychopath, one was a charming psychopath, but they were definitely both psychopaths. But I think that whole kind of, you know, that greed just pervades finance. I mean, you know, some of the discussions that I've seen, you know, in terms of how are we going to make money out of this. I was in one company that kind of had an earn out that sort of, you know, and therefore they had to make a certain amount of money over 5 years, which was then a multiples put on it by the potential acquirer. And the greed that engendered, the personal greed that you see, I think is absolutely huge. But I think also one of the things that people sort of forget about finance is the fact that the greed pervades even down to the clients and what you're trying to do for the clients. What you're trying to do in investing is essentially make your clients richer. And by definition, your clients are all rich because they've got money to invest. And you're essentially trying to make them richer. So, you know, again, this kind of story of separation pervades what we're actually trying to do with finance. And I think the sort of, you know, the sort of, you know, quite apart from the sort of the greed and the psychopaths and all that kind of stuff, I kind of feel that the number one story that we tell about finance and investing is just wrong. And, you know, I think that what finance originally is meant to do is to, you know, circulate people's savings, make sure they get connected to projects and companies, help the real economy. And yet you don't actually get that. And I had a look last night at sort of what the places that I used to work for describe what their purpose is. And you know, I've worked for sort of 4 or 5 places, and they all say exactly the same thing. One of them says, this is their aim, first page of their website. We aim to maximize shareholder returns by delivering attractive risk-adjusted returns for clients and by operating and allocating capital efficiency. So that's one. Second one, we have a passionate focus on serving our clients, and a commitment to delivering superior performance after fees is central to why we exist as a business. And you know, I talked about the Matrix in 1984. That stuff's mad if you think about it. It's totally mad. And yet that's just accepted as, yeah, well, that's the purpose of finance, is to make your clients more money and to do it in a sort of risk-adjusted way. There's nothing there about serving life or aiding the regeneration of the planet, or of the planet. And I don't know how many of you know John Fullerton, who's done a lot of sort of regenerative finance stuff and is a mate of mine. You know, he will talk about kind of, you know, getting objective and constraints the wrong way round. So, you know, I think the typical fund manager thinks my objective is to make a lot of money for my clients. My constraints are ESG or lack of extraction or that kind of stuff, if they even think about that. Whereas I think you need to flip that on your head. My objective is to aid the regeneration of the planet. My constraints are, I don't want to lose all my clients' money, or, you know, I've got certain fiduciary responsibilities, but the fiduciary responsibility comes first. And you know, this is not just the places I work for. You look at, I mean, I looked at the website of BlackRock, it's exactly the same stuff, and they manage the most money anywhere in the world. So I think that's huge. I think there's a failure of kind of moral imagination. There's also this kind of idea that finance can do everything, that, you know, we make things more and more efficient. You know, those of you, and I'm sure there are a lot of you who are sort of from the non-Anglo-Saxon world, you know, I mean, certainly when I started finance, a lot of kind of German and Dutch companies had dual boards and supervisory boards where workers were represented. And I remember that being seen as, you know, as, well, that's ridiculous, how inefficient, and why would they possibly do that, and how can they take decisions? And, you know, and now you look at what many of those sort of, European companies say, and they'll be like, well, in the bad old days, we used to do that. But now, of course, we're hugely efficient. So this sort of belief that markets can do everything, this belief also in growth. And of course, you know, I mean, finance would be dead without growth. You know, I think that Ben Graham, who's the sort of, you know, the doyen of value investing 100 years ago, used to talk about the P of a degrowth company being around 8, and the P of the, you know, of global markets now is more like 20. You know, so if you believed in degrowth, the natural corollary would be that all markets should go down 60-odd% today, with all the problems that would engender for the global pension industry, et cetera, et cetera. But I mean, you know, this whole thing of growth is just baked into it. We used to, you know, I've used PEG. So for those of you who aren't financial, PEG is price earnings to growth as one of the sort of main ways that you look at a company. As in, I'm prepared to pay 20 times earnings for Tesla because I think it's going to go 20% ad infinitum. And any of you who've looked at nature knows that's just impossible. It's, you know, it's impossible for any company. No company ever grows 20% ad infinitum. So you have this just going on the whole time. And I think that, you know, the education that we give people in finance is also really problematic. Melanie mentioned that I'm a CFA holder, Chartered Financial Analyst. And again, I checked this because I wanted to make sure I did mine in the 90s, and I wanted to check to see whether it's still just what it was when I did it. I thought, no, surely now it's going to be totally different. You look, again, it's exactly the same. You know, they talk about ethics. The focus of this topic is ethics, related challenges to ethical behavior, the role ethics and professionalism play in the investment industry. That's their sort of handle on ethics. Again, nothing about the sort of cognitive dissonance of the point of finance is wrong. It's all again about how do you ethically serve your clients, not how do you ethically regenerate the planet. You know, so the education I think that we give our fund managers is wrong. And funnily enough, I find it quite a sort of intellectually lazy profession, and a profession that's sort of stuffed full of incredibly intelligent, well-qualified people. There's no real learning culture, I don't think, in finance. I think people treat finance as a sort of non-complex system where what you have to do is kind of follow patterns that have worked in the past, and sort of all the kind of the theories behind finance, modern portfolio theory and all those kind of things are all based on statistics of past performance. So there's no kind of intellectual curiosity as to why finance doesn't conform to the rules that it says it should conform to, which is why we have financial crises every 2.5 minutes, because, you know, they just don't conform. The other thing I was always amazed by, and again, this is one of these things that once you see it, you can't unsee it, was how little fund managers and finance professionals in general are committed to continuing education throughout their careers. And I used to have this argument with my boss that, like, you know, hold on, Roger Federer is the best tennis player in the world, and yet he practices every single day, and he has a coach, or if you're Roger Federer, you don't, but I mean, most tennis players have a coach who's telling them, Roger, despite you're the best tennis player in the world, look how much your forehand could be improved, or look how much your topspin serve could be improved. Fund managers don't do that. They sort of think, you know, you always hear fund managers talk about how experienced they are, as in just doing something for a long amount of time means you get better at it, which I don't think is true. So there's this sort of, you know, I think arrogance that comes with the financial profession, sort of intellectual arrogance that comes with it. Yeah, things are changing. You know, ESG has been around for sort of 20 years. ESG is another thing which I think the fund management industry or the finance industry has become really quite smug about. You know, this is going to change the world, and yet you look at what ESG has actually changed so far, and I'd argue very little. You could argue that it's kind of opened the door to a conversation about changing the world. But I think there is an argument for saying that over the last 20 years, it's actually acted as a sort of, you know, a kind of fix that fails, you know, something that has been put out there as this is the solution, which has actually stopped us looking at proper solutions. So I think there's a lot to be said about ESG, particularly the kind of lack of stewardship, and the fact that it's become a sort of system of integration you know, if I can tick all these boxes, then this company is okay, even if it does loads of horrible things. And I'm sure, you know, even those of you who aren't in finance, I imagine are aware of things like, you know, British American Tobacco is a fantastic ESG winner. Royal Dutch Shell, fantastic ESG winner. You know, I mean, there are these companies that you think, well, these are companies that are doing harm to the world, and yet they tick all the right boxes in terms of ESG, and therefore fund managers own them and think they're sort of doing some good. Look, I might just stop there and then go on a bit to sort of what I've been doing since then. I don't know if there's any questions, Melanie, or anything that anyone wants to ask.
We can take questions at the end. Of course, I'm wondering now about how to make things better. So I'm curious to hear about the next part of your story.
Yeah, because otherwise it's all pretty negative. So what I've been doing since 2018, I mean, my first sort of aim, as you might imagine, with someone who's pretty disillusioned by finance, was, look, I want to, you know, that's it. I'm going to retire. I want to go and be a dog trainer or do something else with my life. And I have done that to an extent, and I've become quite involved in conservation. But the other thing that I have done is I have remained in finance more than I ever thought I would do. It's not always been clear to me that that's been the right decision from both a personal and a professional point of view. But I have realized that there are probably too few kind of poacher turned gamekeeper people in finance. You're either people, as I said, who sort of either they just get burnt out and leave it, or they're activists who approach it from a position of sort of being anti-finance from their very being, or they're people, like I say, who sort of cynically just carry on in finance despite not liking it very much because they're getting a great big paycheck and paying the mortgage. So I think that people who are prepared to sort of change finance are still very far, you know, few and far between. And impact investing has been one thing that I really have, you know, got into as Melanie sort of highlighted, and I've done that through a few things. I mean, advising on impact investing in listed equities, and that really is something that I ask myself a lot: is this really changing the world or not? Can you really have impact with listed equities? And my kind of answer to myself on that is, look, there are $100 trillion of listed equities. It's the second biggest market in the world. That compares to, people now talk about $1 trillion in impact, but even that's probably stretching the envelope. So it's an enormous market, listed equities. It's also the market that nearly every one of us is going to start off our investing career age, you know, 20 with, you know, people start with that. So it's what people understand. You know, if you look at business pages of any newspaper, it's essentially all about listed companies. And so I found that sometimes frustrating, but often pretty enriching. I think that, you know, that there are things that we've been able to add through what I've been advising on, particularly at UBP, as Melanie talked about. I think we've done a lot of really cool engagement, both bilateral with companies and collaboratively with other actors, with, you know, talking to regulators, that kind of stuff. And I think, you know, you talk to the fund managers that I work with, I mean, they would understand to their core that ESG isn't sufficient. They also understand, I think, to their core that, you know, you can't solve anything in just a finance silo. You have to think about how finance acts with government. You have to think about how finance acts with academia, with non-profits, with external oversight. And so I think, you know, trying to think about that as a system and trying to think about financial investors as just being one part of the system, I think is something that's really important. Now, I think you can do that in listed equities, even if you're never going to have the same sort of pressure as you have in non-listed, in sort of venture capital and private equity. I don't think impact investing is all good, and I think there is a real danger of greenwashing in impact investing. You know, you can see again, I mean, I was looking at a couple of sort of listed equity impact fund managers. and they'll talk about, we are a positive impact investor focused on the opportunities created by the transition to a zero carbon and sustainable global economy. We invest in companies we believe are well positioned to benefit from the transition to a more sustainable economy. You know, you can see the problem right there. I mean, that's again going back to that thing of objective and constraint. It's the wrong way round. And, you know, someone like Triodos, I'll name Triodos because I think it's good, you know, what they say. We are radical in our desire to make impact the standard in investing. Join us in making money work for positive change. I think that's a much better message, but I don't think that's the sort of common message in all impact investing at the moment. And I think there is still this kind of dual mandate where the financial returns and the fiduciary responsibility to make as much money as possible always really trumps the impact. So I think that's something that we're all going to have to really work on, is making sure that that objective and constraint changes. Melanie mentioned, you know, I mean, being on the board, and I'm the treasurer of the Tonic, which is an impact investing community for private wealth holders and sort of family offices and that kind of stuff. I think that's important as well. I think that finance suffers from a sort of agency problem where it's always someone else's fault, and we're only doing what our clients ask, even if we don't really know our clients and we're not actually asking them what they want. I think the great thing about working with private wealth holders is they make the decisions. They're not a BlackRock telling you that they're making decisions on behalf of, you know, millions of shareholders that they can't contact. These are people who are literally, you know, are putting their own money to work. And I think that is, you know, I think a lot of the stuff that Tonic and other organizations do is kind of at the vanguard of what you can do with impact investing. I think, again, you know, looking at, and one of the things that I, you know, really encourage other people within Tonic as much as I can is the stuff that I know that Melanie's been talking about with you. So, you know, non-extractive fund models. How much is it right to charge for funds? You know, one of the issues with the fund management industry is it's hugely scalable. And there's a huge incentive to scale because you charge 1% of management fees. 1% of $1 billion is a vast amount of money. So your incentive to get there is huge. There are funds around, not many, but they're happening, where they'll start off charging a percent when they've got a couple of $1 million under management. And as they scale up, they'll reduce the management fee that they pay. And that, I think, is a wonderful model. I think one of the other things that I'm keen on, I think needs to change in finance, is the sheer speed of how things are done in finance. You know, again, because finance essentially exists to take a kind of cut of every single transaction in the world, you know, your incentive is to make sure there are as many transactions as possible. I think one of the classic examples of this is the fact that stock exchanges all around the world now are listed companies. So they exist now to make money for their shareholders by making us all trade as much as possible, because they take a cut, obviously, of every trade. So I think that, again, any model that encourages kind of finance to slow down is really, really to be praised. And I think an example of that, and I think, you know, Melanie, again, will have talked to you about that, is evergreen funds as an alternative to private equity. So even in the impact space, most funds have a private equity model, which is kind of, we'll run it for 10 years, maybe 12. And within that time, we've got to make sure that we buy, develop, and sell every single one of our companies. So that we can close the fund down with huge returns to shareholders after 10 or 12 years. And that's just not that's just not the way the world works. You know, if you're forcing every company to produce results in your 10-year time frame, you're going to have unintended consequences to that. So I think that evergreen funds, and again, there aren't many of them around, but they do exist. I mean, I'm an investor in a few of them. I advise to a couple of them. And I think that, again, you know, anything that sort of slows finance down is a really good thing. I think people that try to introduce the concepts of nature into finance, you know, this concept of sort of wintering, this concept of you know, the growth is not kind of forever and parabolic. You know, growth in nature tends to follow an S curve. You know, it doesn't grow very much, then it grows a lot, and then it sort of, you know, winters off. If you did that in finance, stock markets would be worth 60% less than they are today. And yet that is that is how nature works. So yeah, I think it's, I mean, and the other thing I really try and do, and that's kind of, why I support what Melanie is trying to do so much, is education, as I say, trying to change the story. And there's quite a few people, I mentioned John Fullerton, Laura Storm, Melanie, who are trying to kind of change the conversation around how finance happens, trying to kind of show people that the way that we think about finance today isn't like some law passed down like the law of gravity that just works. It's just a construct that we've kind of invented over the last 10,000 years if you think it's from the dawn of agriculture, or 500 years if you think it's from the dawn of sort of the Enlightenment. Whatever you do, it's a human construct, and it's not something that is kind of ordained to be. There is no reason why we couldn't do what I said, which is basically say the objective of finance is regeneration, and we have constraints of how much money we can use towards that. The other way around is just a weird thing that now everyone sort of believes in, this kind of Matrix 1984 world of finance that we tend to live in. So I think, education is a huge part of this, and trying to change kind of paradigms is a huge part of that. We haven't talked about benchmarks. I mean, benchmarks is a terrible thing. When you get this sort of, how fund managers measure themselves, how do they determine that they've done right by their clients? All those things that I said at the beginning about fiduciary duty, and our duty is to do well by our clients. Pretty much every fund manager today will measure that by some sort of benchmark, whether it's an IRR of 14% if you're a venture capital fund, or we want to beat the MSCI World Index if you're a fund manager. These are all just constructs. They don't make any sense. No one's asked me whether I want to beat the S&P 500 or not. As a private investor, I probably just want to make a bit of money. And maybe if I'm a rich person, I don't even want to make a bit of money. Maybe I want to spend down my money. Nobody's asked me that. It's just assumed that everyone who participates in the world of finance wants to beat the benchmark, which again is sort of Matrix style lunacy. No one's ever asked anyone about that. It's just kind of happened. We need to look at other ways of measuring things. Why aren't companies and fund managers measured on, regeneration, how much carbon they've sequestered, whether they've respected the limits of a finite planet. There's a whole load of things that could be done, I think, if we had the courage to sort of have those conversations. And I guess, the final thing I'd say is that it's hard. I mean, I think that I'm sure, Melanie, you find what you do hard, because it still is very, it is outside the matrix. And not many people believe it yet. And I think that, as I say, for every person that thinks they're making a difference, there are another 10 people who don't think that's finance's job. There's probably another 3 people who think, but we've got ESG now, aren't we saving the world already? So it is hard, but I would encourage you all kind of not to give up. I mean, I think there are many, many things that we can do in finance, as long as we realize that, finance is there to sort of serve the world, serve the economy, humans and the natural world, and not the other way around. We've got to this kind of world where finance seems to dominate everything. It should be there to serve the vets and the teachers amongst us, and not sort of, not the other way around. So there you go. That was, I know that was very unstructured, but I hope some of it made sense.
Thanks, Simon. So I have 2 questions here from the chat. I'm going to start with the more concrete question, and then I'm going to finish with the more general question. The more concrete question is, can you give examples of funds that work with reducing management fees when they scale?
So yes, I can. Is that okay, Melanie? I mean, I don't want to sort of.
Yes, of course, please.
Yeah. Okay. So there's something called Project Snowball, which I work with in the UK. So they do exactly that. I know that Melanie knows them. There is a fund in Paris called 2050. By the way, and it won't surprise you, both of those are run by women. What a surprise. There's a fund in Germany called Purpose Capital, and a lot of them have similarly sort of regenerative practices. So a practice of reducing management fees, practices of being evergreen to some extent, practices of having proper supervisory boards and kind of golden shares that ensure that these things get done. Yeah, so there are examples around, but I mean there are not many. And I think one of the things that I feel very passionate about is making as much sort of noise as I can and helping these people with advice and with investment as much as I can, because it's only by scaling that these things will work. And I mean, a classic example is if you do that and yet all of your competitors run an extractive model, it is likely that all your competitors are going to be able to poach all your very good sort of 30-year-old analysts who need to pay their mortgage, because they'll be able to pay them more. So until the thing becomes systemic, you're always going to run the risk of bleeding your best talent away. And that's something I think if you talk to all of these kind of entrepreneurs, they'd say the same thing. So yeah, there are examples.
Thanks. Then I'll get back to the other question. So Simon, what is your definition of impact investing, and how can investing be designed to be impactful?
So I think so there are classic definitions of impact investing. I think that the things that are sort of the most important is firstly the intention. So the intentionality to do good with your investment, and not only to make money. I think there are shades of impact investing. I think there are probably too many impact investors who've got that my sort of equation the wrong way around, as in, if we can make a lot of money whilst doing good, then we're happy. I think that doing good and regenerating has to come first. I think you also need, the sort of buzzword is additionality, as in your investment has got to make something happen that wouldn't have happened otherwise. That's one of the great criticisms of, can you impact invest in public markets? If I give my money to some fantastic listed regenerative company, but all I'm doing is buying shares from Melanie, I'm not giving money to the company, I'm not investing in the company changing. Is that really impactful? What's the additionality there? But I think the main thing is the sort of, doing good is at least as important as making money to you. And I would certainly argue it should be more important, if that makes sense.
Thanks. One last question from the chat before we go to Alex. If finance is there to serve the world, how would you go about doing that at scale?
So I would slow it down massively. So I would try and ensure that finance isn't the reason why things get done. I'd want it to support how things get done. I would get rid of any of this concept of fiduciary duty, being I want to make as much money as possible for my clients, or I want to earn risk-adjusted returns. I would swap that paradigm at the start. So nobody is allowed to talk about that anymore. Nobody is allowed to talk about benchmarks anymore. Nobody is allowed just to measure their performance by financial returns. Everyone has to give me, however many measures you like in terms of how we're serving life. So I'd really want to start very, very deep with the sort of paradigms and the stories around finance. I don't think that if you want to change the world, you can just tinker with it. I think otherwise you get that sort of fix that fails problem that I think you get to an extent with ESG.
And Alex, you have the last question for Simon. Go ahead.
Hi, Simon. Thanks for your story. My question is a bit related, maybe a bit broader than your view, but I recently came across an idea to take capital, labor, and land out of the market as a whole. Have you come across this idea, and do you have any thoughts about it?
I've come across it. I've not seen it in action. I think it's an amazing idea. I mean, I think that this sort of, I didn't really talk about, the idea of the commons, for example, which is an idea which gets floated around a lot in sort of quite restricted ways, but should be applied, I think, hugely. I mean, I think the fundamental, one of the fundamental problems of capitalism is that people get rewarded for stuff that is the result of the whole of human civilization. I mean, the fact that Elon Musk or Jeff Bezos are some of the richest people in the world, I find ludicrous, in that what they've invented is this tiny little tip of an iceberg on top of this whole iceberg of, right back to the invention of fire and the wheel. But I mean, even closer to that, the invention of the internet and the invention of electricity to power the internet, and et cetera, et cetera, et cetera. And the only way to deal with that is basically to put all of this into sort of common use and for people to pay for it. And you give everyone a universal basic income on the back of what all of our, what all the generations of humanity that have gone before us have done. And that's still too human centric, right? Because that's still talking about humankind as having dealt with all this, rather than the earth as having, made itself habitable for us to do all this stuff in the first place. So I think, Alex, we're, absolutely. And I think that's the challenge, I certainly find one of the challenges in my life, and I would imagine all of you, if you're here, find it one of the challenges in your life, is how do you go from these great big ideas without going and sort of hiding under a rock or kind of just succumbing to the matrix, because it's so much easier like that. How do you carry on trying to sort of improve things incrementally, whilst knowing that the ultimate sort of destination, it depends on so much more than even the 8 billion people on the planet today. I mean, it depends on us and generations to come. But I think that the sort of overall view that capitalism needs to be radically changed, not just finance, but capitalism, I have huge sympathy with.
All right. Thank you so much, Simon, for joining us. I think all of us found this extremely interesting. So thank you for your time and your wealth of experience.
Thanks very much for listening to me.